So aggregate demand and aggregate supply define our model, and we have to figure out how they interact. So aggregate demand and supply will interact like any demand and supply to determine the amount of production and the price level of the goods and services that are sold. Aggregate supply reflects the total quantity of output that we sell, and the aggregate supply curve, we'll see in a minute, shows us that amount at every price level. So at a given price level, what do firms want to produce? The potential GDP is the maximum quantity that the economy can produce given full employment. So if we're using all of our resources to the max, and we've got labor, physical capital, technology, institutions, how much can we produce? That's potential GDP. And full employment GDP is another name for this. So if we're at our potential, if the economy is using all of its labor, physical capital, technology, institutions effectively, we'll be at what's called full employment. And that's an important term to keep in mind. So aggregate supply shows us this relationship between price level on one side here and real GDP. Remember, real GDP is basically production of final goods and services in an economy. And so at every price level, we would expect that as prices go up, this is again holding production costs constant. We're saying, oh, prices go up for final goods and services, not intermediate goods and services, because that would be the cost of production. So as prices go up for my final goods and services, wow, prices are rising, my costs are the same, I'm going to produce more and make more profit. So we see that there's a positive relationship between prices and production. This relationship we see is relatively flat here at low levels of production. Okay, so if prices go up, companies want to produce quite a bit more, but we can see that production levels, even if we increase price a lot, at some point we can't really go too much further. So it becomes quite vertical in the end. It's relatively horizontal here at the lower end. And why do we have this limit? Well, because we have this idea of potential or full employment real GDP. There's a limit onto how much we can make. The economy only has so many people, so much technology, so many resources. And if we try to go beyond it, and here we've got an example of up here, for example, we want to go beyond it. If we try to go beyond our production, we're pushing the economy harder than it can really go. And when we do that, we start generating high degrees of inflation and prices go up quite a bit. So we can try to go beyond this long-run aggregate supply, the LRAS, versus short-run aggregate supply. But as we do, we're really going to put pressure on the economy, and prices are going to start going up quite a bit. So that's supply. Now, demand is the amount of total spending on domestic goods and services in the economy. It determines real GDP. And demand is made up of these elements. We've seen this before. Consumption, investment by firms, government spending, and net exports. Exports minus imports. And what we see in this demand curve is the relationship between every price, the price level P2. Well, if prices are really high, we're going to demand a lower level of goods and services. As price levels drop, the general price level, remember this is like the deflator, as price levels drop, we'll want to buy more goods and services. So the demand schedule, or this demand curve, tells us how much at all price levels we're ready to buy of final goods and services. It's the demand curve for the economy. But it is, and this is really important here, it's broken down into different elements. It's broken down into consumption, investment, government spending, and here we've got net exports. And those four components, 1, 2, 3, 4, are what's going to drive economic policy when we decide, well, how can we maybe change demand in the economy? So how do they work? Well, if you've got demand here and you've got supply, then we have what's called economic equilibrium. So market equilibrium occurs where supply and demand are equal, and where supply and demand intersect, where we get the price level and we get the level of GDP, real GDP, the amount of goods and services produced in the economy. And that's our market equilibrium for our macroeconomy. Now, the short run in the aggregate supply and the long run aggregate supply work together. We can see here that the short run aggregate supply in this case is basically here, and the demand is intersecting at a point that's below our total long run aggregate supply. Long run aggregate supply again is vertical. It's basically telling us the limit of what we can potentially do. And here this is called a recessionary gap. And I'll explain this to you. Here we've got a situation where we can produce out to here. Our potential for the economy is here, but in fact we're only producing here. We're lower than our potential. So it's kind of like when you were looking at the business cycles. We know our economy goes up and down like this, right? And there's a trend line that looks like this. So if we're at a point here, for example, if we're at a point here, our production is low and we could be above it. The trend says we can be up here, but we're actually below it. So here we've got a case where production, GDP, is actually below the potential GDP, which is here. So we're in what's called a recessionary gap. And this is where we get unemployment. I mean, the business cycle says we're below GDP, potential GDP. So we're producing less than what we could be producing, which is out here. Guess what? We have unemployment. If we get to this point, if we can expand the economy out to the long run aggregate supply, then we'll be at full employment, and full employment real GDP as well.